Australian share market has been hitting record highs lately. Prices recovered what they lost after the shock of Donald Trump's proposed tariffs in April, and then just kept going when the tariffs came true. Prices are now 36% higher than the pre-GFC peak and 30% higher than the pre-pandemic peak. So have investors gone crazy again? And is the share market about to crash again? Well, maybe. Shares are mostly valued according to the forecasts of earnings per share, or EPS. And on that basis, the market has indeed left reality behind. But that's not the only way to look at what company shares are worth. Forecasts aren't always right, so what if you compare prices to actual or trailing profits? On that basis, prices are well above average, but nowhere near the peak that normally precedes a crash. And you can also compare prices to the book value of assets. That is what companies say the stuff they own is worth. And that's called price to book ratio. Again, it's above average and about the same as before the 1987 crash, but not the 2000 and 2007 peaks. And then there's comparing the value of the share market to the whole economy, or GDP. That ratio is well above the long-run average, slightly above the 10-year average, but also well below the highest it's been, which was 2007. So there is some evidence that the market is overheated, but it's not really conclusive. There are a couple of things to add. First, we usually follow the US market, and it's definitely at peak valuation. No matter how our market is valued, if US stocks get burnt, we'll be toasted. And then there's that famously true quip from John Maynard Keynes: markets can remain irrational longer than you can remain solvent.